flow. It's almost this kind of sick inversion between the health numbers and the market numbers.
Well, you have a foundation that's been provided by the Fed and, frankly, by Congress as well. I know that we're talking about a fiscal package that won't be as large as the CARES Act was, but we certainly anticipate additional aid, and it does sound like that's going to come. The challenge here is that this trade, as long as there continues to be this fear overhang, combined with somewhat improving economic data, people are looking for safety, and safety is in these large cap tech names, not just tech, but obviously Amazon's consumer discretionary. But so the challenge here is strong balance sheets and a feeling that we're going to continue to have stimulus that couples to create a back to a new normal. What was working prior to COVID? These companies. What could work better after COVID and continue to receive a tailwind? These same companies. The story's not as clear for some of the cyclical sectors. If you look at financials and energy, industrials, materials, there's that second derivative or that inflection point in the economy that's necessary for those companies to perform and take full advantage of the Fed and fiscal tailwinds. Yeah. We don't feel confident in that yet, and so therefore that's why you're continuing to see the trade into the names that have worked.
Okay, well, let's talk about that safety trade, if you will. We ran this morning on Worldwide Exchange, 5 a.m. Eastern time, by the way, Jim. And this comes from Jim Bianco, and it is the weighting of the top 5 stocks in the S&P 500 going all the way back to 1960. Now, believe it or not, we were actually had a higher weight of the top 5 stocks in the early 60s. But look at this chart. The top 5 companies now account for 25% of the market value of the S&P 500, 10% more than in 1999. That, according to Bianco Research. Is that safe?
Well, let's dance a little bit with this, because there's other ways to look at it that actually accent the point. That number of 25% that you just quoted, that is higher than the combined total weighting of the financials, industrials, energy, and materials in the S&P 500. So that's one way of looking at it. Is it safe is your question. The answer is, I don't think you can really make a claim that these large tech companies, large consumer discretionary companies are going to come down anytime soon. The fundamentals of their businesses actually support it. But what's the other side of that is the stocks that have been left behind. And Brian, think about the S&P 500 equal weight, okay? Year to date, before the market opened today, it was down 13.3%. Compare that to the S&P 500 market cap, which was down 1.3%. That 12 percentage point gap tells you that the average stock in the stock market is really still having a lousy year. It doesn't feel this rally. So that actually perversely leaves some room for those left behind stocks to maybe start to catch up. I don't think you have to have the high flyers come down, but having a balance between those high flyers and some of the stocks that have been left behind is the strategy I'm taking.
Yeah, Megan Shu, I kind of feel like it's a Budweiser commercial, because you've got these 4 big horses, the Clydesdales, pulling the entire market cart. And as long as they keep going, the market can probably go with it. Jefferies out with a note this morning suggesting that the market is beginning to look euphoric, their word, just like in late 90s with what they called the 4 horsemen, which were Microsoft, Cisco, and a few others. Can these horses, if you will, 5, 6, 7 of them, can they keep running?
I think it's a very different environment than what we saw in the 90s. These 4 horsemen, 5 horsemen, however many you want to lump into that basket, their business models are very different. They're part of a new economy, essentially. So do valuations still matter? Yes. And I think any analyst or discussion about throwing out valuations altogether is definitely concerning. And there are some undertones that are reminiscent of the 90s. But we don't think we're in that bubble territory. We think these are really solid companies. And importantly, if you are expecting a somewhat slower return to normal, which from an economic point of view, that is the camp that we are in. We are not expecting a sharp V-shaped recovery.